So let's try and put some context around what's been going on in 2022 so far, so you as an investor can understand the simple things that are happening and make sure you make logical, rational decisions. Let's go back to 2020. Pandemic hits, central banks need to basically save the global economy because we saw everything shut down. We haven't seen a pandemic since 1920 Spanish flu. Worldwide economy stops. The central banks and governments need to inject massive amounts of stimulus to be able to ensure we don't see a deep depression. They did that successfully. They continued to pour fuel onto the fire to make sure the economy stayed strong and the consumer kept spending, businesses kept borrowing, etc., etc., etc. It worked. But the problem is they actually left the punch bowl on the table for too long. Inflation went up, asset valuations got overpriced, and even the leaking boats that actually were leaking prior to the pandemic, they actually got saved. They even went higher. I'm talking about the companies that actually don't make money. And by the end of 2021, inflation is soaring around the world, and central banks are realizing, hey, we've actually left interest rates at zero. We've kept stimulating economies for too long. We're now going to have to basically slow the economy quickly, slow consumer spending, and try and get inflation down. And what we've seen happen in the first 3 months of this year, we saw traders price in high inflation, price in high interest rates, and now what we're seeing right now in May is traders are pricing in the potential for slower growth. We are going to see a potential garden variety inflation-induced, interest rate higher-induced recession. Now, I'm not here to predict we're going to see a recession, but what I'm going to tell you is this, is we're going to get past this. The world is going to continue. We've seen this dozens of times previously. What needs to happen right now is wealth destruction. And I'm not talking about people's entire wealth being wiped out. People need to feel poorer. People have felt very rich in the last 2 years. People have felt like, hey, my portfolio, if you've entered the share market in the last couple of years, your portfolio should be up 30, 40, 50% prior to the recent pullback. You felt rich. Your bank account was probably greater than what it stuffed with money from governments and stimulus and programs that have been, put out there. There were a lot of people making more money sitting on their asses at home than they actually were going to work. I know that's not the case for everybody, but it was the case for the majority. More people, the facts are more people have more money in their bank accounts right now in the United States and in Australia than ever before in history. They felt richer and they're spending, and that drives up the demand, and that's what's driven up inflation. It can't stay that way. It has to be readjusted as these dogs. What are you two doing? Come here, come on. I'm not so low, good girl. Charlie has no idea what inflation is, but she certainly knows when it's dinner time. Come on, get down. So what we're going to have to see is we're going to have to see some wealth destruction, which basically means people feel poorer and they're going to spend less. And when they spend less, the demand goes down, the inflation comes down. They don't have to keep putting interest rates up aggressively. But great quality businesses will continue to earn more money in the future. If we don't see a recession in 2023, I can tell you now, share prices are going to snap back very, very quickly. But if we do see a recession, it's likely to be fairly short, sharp, because right now the consumer is very wealthy. We don't have over asset prices in share markets because we've actually had them meaningfully decline. For example, when we go back and look at 2008, the PE ratio for the S&P was 65. In 2000, it was 45. Right now, it's 19.8. Share prices are not expensive. They've been meaningfully adjusted in the last 4 or 5 months of 2022, and a lot of companies now are trading at fair valuation. Now, could we see share prices go lower? Yes, of course. Are we likely going to see Walmart, Target, Lowe's, Costco, etc. pass on higher prices to their customers in the next 6 to 12 months? Yes, because they weren't doing it in the last 4 or 5 months. We just saw that with their Q1 earnings reports. They're going to pass those on. Their earnings might be a little bit weaker, growth might be a little bit weaker, and we might see a recession. At the end of the day, we've seen this number of times before. Share prices will recover, economies will recover. What it is going to take is time. What is required is patience. And if you're a short-term person and you don't have a time horizon of 3, 5, and 10 years, and you're just thinking in the short term, well, I'm sorry, you're shit out of luck. Because right now, we are not going to see share prices snap back quickly like they did in 2020. It is going to take some time, and it's going to require some patience. So the bottom line is, what do? I'll tell you what you do. You stay calm and you keep investing. You take advantage of great quality businesses that are trading at fair and discounted prices. You buy them and you sit on your backside. But make sure those businesses are businesses you understand. They have superior competitive advantages. They're run by competent management. You understand the businesses and you're prepared to sit on your backside for the next 3 to 5 years. And if you're prepared to do that, you will do very well. But if you're not and you want to do things short term, then good luck, because nobody that invests and trades that way makes meaningful returns. Until next week, guys, have a wonderful weekend. See you next time.